Just tell folks, like, so what did you sense? What did you feel before that crash in 1987? Like, what made you feel with conviction? Because you went out on a limb and said, this is going to happen. You didn't say maybe, sort of, kind of, shoulda, coulda, woulda. You said it's going to happen, and it happened. What did you sense and feel back then?
Well, back then we were running technical models. So we try to take, now they call them quants. So we had programs that measured a whole bunch of things of the stock market in general, which things I don't do today, but because the market totally changed. And what we were seeing there was, so interest rates were ticking up. The number of stocks advancing and declining kept narrowing. The number of new highs versus new lows kept going down. So you had really a bifurcated market. You had just a handful of stocks going up and everything else going down. And October 6th is when we got all our clients out of the stock market into cash. We didn't know the magnitude. We knew it was going to be bad because everything was so stretched. But over that weekend, I think it was a Friday, October 16th or 17th, I forgot the exact day, where James Baker was Secretary of Treasury at the time, I think Treasury or State. I don't remember exactly his first position during this period. And there was a meeting in Europe, the G7 meeting, and there was something to the effect they're going to let the dollar get stronger, weaker. I don't remember all the details. All it was, as soon as midnight, I think it was like 5 or 6 o'clock, New York time on Sunday, opened up the Nikkei market, Japanese market started falling, and it was just a cascading effect. So when the New York Stock Exchange opened, it was already down a couple 100 points on the open. And it just, all the buys and the buys were virtually non-existent. And there was just sell after sell-off. It was just an avalanche. It was something I was only managing money at this time, Paul. I think it was 87. So I was a whole bunch of, I just turned 25. And I was in a year and a half of managing money professionally. We just set up a shingle on the door. And here we were with our biggest test right up front. And it was devastating. It really was.
And from a personal basis, did it change your life having made that call? Because I remember reading about you. I remember you were on the front page of the Wall Street Journal. And what happened like after that for you? Because I mean, I know what happened with the markets, which is that in the end, it didn't end up anticipating a whole lot. I mean, the next recession was in 1991. I mean, it was totally a function of, like what you said, a mechanical issue, portfolio insurance and all this stuff. But what happened for you, like as a result of like having made this like incredible call?
Well, yeah, we weren't on the front page of the Journal. We got a nice column in the New York Times, but because it was chaotic. It was really chaotic. And for myself and my firm personally, it put us on the map because that day washed out a lot of money managers. It just, if you were caught in that, and it washed out the money managers, Paul, who sold out during the panic. That was the key. If you did nothing, if you fell asleep for the next 48 hours, I wouldn't say a big deal, but you missed the brunt of it. It was during the fear time that people sold at the low, which was absolutely insane. And for us, it just actually put us on the map. We got a lot of great press. I was old 25 years old at the time, and I thought that, wow, this stuff's supposed to happen like this. And everyone was telling me, no, these events are rare. And it was pretty trying because if you could hold your own during a time of calamity, panic, and fear, and keep a steady eye on the horizon and know what you're doing, investing becomes a lot simpler. But if you freak out and get very emotional, which I saw a lot of people and a lot of friends that I knew who were managing big money, they just got what we call blown out of the water. They just sold out. They didn't get back in for weeks, months, and the market just took off without them. And they can never make up that gap between what the S&P was doing and what they were doing. And they kind of proved the point that it's very difficult to time the market, which they were trying to do.
Right. I mean, this is from someone that was a 7-time market timing champion. So, I mean, I tell my readers, and I know I watch your updates. I know you tell them like, hey, forget timing and all that. Nonetheless, it's still a pretty popular thing to do. And I actually like think of it as like sort of like there's a line to sort of collect your rewards. And every day there's a temptation being dangled in front of you to get out of the line. Sometimes the temptation's small, sometimes it's big. But then like by the time you get around to like thinking like, oh, I really shouldn't have gotten out of line. The line is like way longer. And everybody that just continue to do nothing and stay in line, they're way closer to getting, the big rewards.
Yeah, absolutely. People just don't realize it's inverse of what they feel like. You work hard, you make money. This is the only business I know that the less you do, the better you do.
Right.
It's kind of counterintuitive because once you do all your research and you buy a position in a company, and if your analysis is right and your research is right, just sit back, kick your feet up and let the company do everything else. Leave the driving to us. You don't have to be trading in and out.
I 100% agree. And again, we're going to get to the topic of recessions because this is relevant to it, because people think that calling the recession, knowing when it's going to happen with some perfect precision is going to be the critical factor. And, I've got a number of questions, on Twitter. And while, our strategies are slightly different, like I say, let the market do the work. Charles, would it be fair to say that you say, let the companies do the work? That might be like maybe like the easy way to like sort of differentiate our approaches.
Yeah. The big difference between us is, and there's a lot of similarities. We're trying to find companies that are going to lead the field. We're going to try to find companies that are doing something different, that have a competitive advantage, that are able to produce higher earnings and revenue over the next 5 and 10 years than they are now. Because really what you're doing in investing is you're putting money today to reap more money tomorrow.
Right.
So how we both go around that formulation is a little different. I value the company and you value the stock and the price movements. But at the end of the day, we're both looking and trying to figure out how big is X representing where the stock will be in 3, 5, or 10 years,
right,
and what we want to pay for today. That's really all it is. It's a bird in the hand is worth 2 in the bush. So we want to know how much that bird in the hand cost and how much it will be worth for those 2 birds in the bush X period of time later. That's all it comes out to be.
All right. Now we get the heart of the matter. So when I texted you, I said, hey, Charles, would you like to come on and talk about one bear market crisis, crash, whatever you want to call it, that you went through and how it turned out? So you only can pick one, and I'm going to pick one too. But so pick one and then talk a little bit about, what happened, what you did in reaction to it, and then how it turned out.
Yeah, that's easy. It was 07, 08. It was the financial crisis of 2008. Okay. That was building up. And I wrote an article in my newsletter at the time in I think it was September of 05. And I went to a bike store for one of my kids' bikes, needed a flat tire fixed. And I saw on the counter, the owner of the bicycle store was also selling in real estate. And he gave me his card. He goes, if you're looking to buy a house or buy a building, please contact me. And then I remember coming home and writing the article and saying, when the bike repair shop is selling real estate, we're at a top. It's everyone's getting into this game. I didn't know how bad the housing bubble was. I didn't know how terrible it was. It's going to turn out, and how it almost took down the financial system. But that was the first time, 05, I saw that there was smoke on the horizon. And then I think the market made a all-time high. I think it was October 2007, and then the wheels just came off the cart. 2008, I think the end of the first quarter, you had Bear Stearns doing terrible in one of their funds. The real estate fund everyone was betting against. They weren't betting. They were doing these subprime. Let's not even get into that. But it just looked like a terrible storm. And and then I was managing a hedge fund at the time, and we had really outstanding companies in the portfolio. These companies had strong balance sheets, and they were earning money and great revenue and great earnings. And I told my partners, I said, we're going to be in for rough waters here, and I'm not going to time this because who knows. But I'll tell you one thing, that if you're in a storm, if you're crossing the Atlantic, you want to be in the Queen Mary and not in a rowboat. And our portfolio is the Queen Mary. So it might get tossed and turned a bit, but we're not going to be capsized. And we started to add to it as things got worse. And at the end of 08, It was even worse when Lehman Brothers, largest bankruptcy in history, went bankrupt. Market just plunged even further. I think by March 09, I think the S&P was down 50 or 55% from the peak. And all we were doing through that time period is we were adding to our positions. And then March 9th, I think it was 09, or I think it was March 6th or 9, I forgot the exact day. Everything
March 9th, definitely.
March 9th, it just stopped. It was like a summer shower and passed. But the thing about it, Paul, it took, and you could learn so much from what happened 11, 12 years ago, is the retail investor did not get back into the market. And the reason they know this is by mutual fund inflows and outflows. The retail investor didn't get back in the market until it was already up 100 or 150% from the bottom. So they missed this big chunk of gains trying to catch it later. And then when the market just went down a little, I think it was 2015 or so, a lot of them got back to even, which was ridiculous. So it was the classic situation of, sell low, buy high. They were doing it all over again. And you asked for a lesson, what that told me. It didn't teach me anything per se, but it did solidify in my mind that when you know what you own and you did your research and you did your analysis, and events like this happen, because they will. Every, bear markets do come. They didn't repeal the laws of gravity. You have more conviction and you have more confidence to stick with your position. I think you call it what we call on Wall Street, as your subscribers know, strong hands. And it's constantly a game of the market trying to take your positions away. And they take it from the weak hands. Those people who panic and need to sell, that they don't want to sell, but they need to sell. And the strong hands players over time just continually make money. That's really it.
Right. I mean, so if I can summarize this, which is that you actually anticipated that something bad once again was going to happen, and you saw the storm coming, and from past experience, you realized that the thing to do is not to, go back to shore, if you will, and hunker down, was to say, hey, these storms, they're a fact of life of being at sea, which is like being in the market. And you are prepared by either, again, you said you had the, battle-tested ship. You knew what you were doing, you were experienced, and you knew that if you made it through the storm, you were going to be so far ahead of everybody that tracked backward and, build a bunker and sat there waiting for the all clear. Meanwhile, somewhere past out at sea, there was sunshine that they could never see.
Yeah, you summed it up great. People don't realize they don't ring a bell at the top and they don't ring a bell when it's over at the bottom. So bear markets do come. They come with regularity every 7 years, sometimes a little sooner, sometimes a little later. But on average, they only last around 18 months. And it's during those 18 months that people just do silly things because they just want to stop losing money. But you're not losing money if you don't sell your position. I still own it. And if you don't have leverage, you're not using leverage, no one's forcing you to sell. So just basically don't do something, just sit there. And that's really it.
So I have to ask you something, which is that why is this like such so I put this up on Twitter and I got a pretty big response. I have a few questions and my team was like, we're seeing a lot of these questions come in. Why is this such an obsession to want to avoid something that a look at any chart, any index of the S&P 500, a chart of a company over time, everyone can see that there's volatility, there's ups and downs, and yet that is just never enough. People still feel the desire and need to want to go in and out, and it takes extraordinary, psychological gumption to sit there and do nothing.
Yeah, 100%. And, I remember back in the day when I was managing my mother-in-law's money, which I still do, but back in the day when she just wasn't geared to my style of investing, when the market would be plunging, she'd be calling me, what are we doing? What are we doing? I said, I don't even know what's plunging. I didn't even have my screen on. That was the days before iPhones, and you had to actually have a ticker tape, not a ticker tape, but a Quotron or something to give you information. It wasn't the way it is today. And I said, I really don't even know. It's on TV. I said, who cares? You own great companies, and over time, we're going to do well. Do something. What do you want me to do? Okay, hold on. I'll be right back. She goes, where are you going? I'm going to do something. You want me to sell out? No, don't sell out. I said, so what do you want me to do? It's the feeling that, you know what it's like? It's like when you're in an airplane and there's turbulence, you feel helpless. But if you have a good pilot and you're in a plane that's mechanically good and computers work and everything, you know you're going to get to the other side. And you really can't do anything about it. I think the ability to do something is a mistake, because if they told you every stock you bought you had to hold for 10 years, I guarantee you, Paul, individual investors and institutional investors would be a hell of a lot wealthier than they are now. That's a fact.
This is true. That's absolutely true. I mean, you raised the story about people who got out in 2008. I'll make a couple of points about it, which is that the lows aren't made, folks, because everybody's buying. Just want to make this clear. The lows are made because everybody is throwing their stock at insiders, market makers, the truly, truly smart money that is just sitting there and saying, oh, you want to give it to me at 80% down? Sure. What else you got? I'll take some more and I'll take some more. Oh, you're worried about the recession? Oh, you know what? You should be worried. Send us some more of your stock. Send us more. And then don't worry, we'll sell it to you during the boom. We'll sell it back to you, marked up 300, 400, 500% back to the boom. That's approximately what happens pretty much in cycle after cycle. And yet it repeats itself, Charles, again and again. And, once again now, with the Federal Reserve saying that they're going to increase interest rates, there's, of course, like the CNBC, New York Times, Wall Street Journal, the media cabal is on our readers who, they don't know what, necessarily think. They think that these journalists who have never managed money, who have never done a thing, that they know something. And so what they read or what they're seeing on CNBC or on television, that is something that they should follow. And so what we tell them sometimes, it's dissonant to their ears, and then much later on, much later on, often near the next top, that's when they get in, and then they get, like sheep, they get sheared again. And it's just like this continuous process.
During a panic, people are selling dollar bills for 50 cents, and they're more than happy to buy them back at $2, which
10 cents. I mean, in my market right now, it's the growth stock market. I'm just going through my companies and I just go actually do one thing. I go look at how much cash they have, and they're, half their value is in cash today. And so then I just, like, for fun, I just combine their revenue plus their cash. And I just think, like, wow, you're actually getting all the future growth now for nothing, for free. And so, my story from 2008 is that I, as was managing money too at the time. We had a very large hedge fund, which was levered up. And we had a number of very, very high profile clients. So I've signed a non-disclosure agreement, so I don't want to say what the name is, but it's a furniture company where it begins with an I and ends with an A. So their family office had given us hundreds of millions of dollars. And they had hedged our strategy by doing something that, like, we had to just kind of like wrap our brains around what they were doing, which is that they wanted to only capture the upside, right, in our portfolio. So they gave us their hundreds of millions of dollars, and then they were short futures. And the idea is that to the extent that we outperformed, they would only capture the upside. Well, obviously in 2008, let's just say, was not the best time to put this on in various ways, because both sides of that strategy just didn't pan out, mathematically didn't pan out. And, and this is despite, in other words, people with a lot of money. And I can tell you that family office, when they came, 3 cars pulled in with, loads of analysts with books this fat about every bear market in history, every crisis in history, everything known possibly about every asset class you could imagine. They had simulated all kinds of things, and yet they got it wrong, folks. So they had supposedly prepared. And I've told my readers this, which is that, we told them and everybody else, which is that, hey, exactly what you said, which is that this is a terrible time to sell. This is a terrible time to sell. And if you're just simply willing to give this a little bit of time, even 6 months, 12 months, because you could see like all the things that were being done, which would eventually, get the psychological profile of the market where somebody was going to come in and pay slightly higher prices. And sure enough, that entire portfolio was up 150% and from the lows, 150, 200%, 12 months later. Yeah. So, I mean, folks, I know you want like, hey, is there going to be a recession? Oh my God, should we get in, out? You got two market pros telling you, and I don't know, all the richest people who have made all the big money, Warren Buffett, I don't know, who else? Who else do you think about in your way of investing?
John Templeton, Charlie Munger, Jeff Greenblatt, Stanley Druckenmiller, Soros. They didn't do it by trying to time economic events.
Or even think about people who have built their companies through, like, think of Jeff Bezos. How many recessions has the man built Amazon through? Amazon, starts in 1993. So he begins during a recession, back then, and then goes through 1999, where his stock collapses by 80%. And still the company keeps going, goes through 2008, goes through all the mini crises we've had since then. And I don't think he sold a whole lot of stock through any of that.
But he became one of the richest men in the world by building his business and not watching the stock market, So really, you bring up a really good point is there's a difference between the stock price and the business, because sometimes Mr. Market just gets it so wrong, especially during panics. And you mentioned, some growth stocks you're looking at now with cash in the bank. I remember back in 07, 08, you had Microsoft and Intel, and you had some mega companies, just unbelievable technology companies of its day, and regular companies like Disney. They were selling at 8 or 10 times earnings, which is a joke. Which is I can't say I wanted the value. You could have just thrown a dot, and you would have made money. And then you had periods of time where you had back in 2002. I remember after the .com, and I'm sure you remember this as well, is you had tech companies which were selling for less than the cash that the company had in the bank. So you had a company with a market value of, let's say, $500 million, and they had $600 million in the bank. So you were buying a dollar bill for less than it was worth. It's just a joke, but that's what happens at market extremes.
This is right. The psychology of people is that they want to know where the recession is. Maybe you might even get that right and get out. But the real critical factor to making money is actually when you get back in. And generally people tend to sell somewhere near the bottom, and they don't get back in for a very, very long time. And then as a result, miss out on the wealth creating part of the market.
Yeah, they sell low and buy high. And you just don't get rich doing that. And the thing is that when people just don't realize, I'll get back in when the coast is clear. My gosh, when is the coast ever clear? The future, by definition, is unknown. Did anyone expect COVID to shut down the market? Did anyone expect the market, when it was in a bear, to actually make all-time highs? All of these things are not planned. And if you go back to, I think, the November issue of every year of Barron's, they have analysts from the major brokerage firms try to predict where the stock market will be a year from now and where interest rates are going to be. And I always look through that every year and I chuckle a year later, because the biggest concern back in 2019 for 2020 was going to be inflation. And that's exact opposite. Nobody had COVID. So why would I care? Sometimes I get emails, I'm sure you do, from subscribers. So-and-so says this, what should we do? I go let them manage your money. Go get their, I don't look at them. I basically hold to my own analysis. Why would I even bother just taking what someone else says as gospel when I have my own data, my own information, my own world experience? So you stick to what you know, the confidence that you have in your analysis, and more importantly, it's compounded knowledge. I thought I knew everything back in '87. I realized by 1990, the next recession, how little I knew. And then by 1997, 98, when the Far East collapsed, and Russia defaulted on their loans in August '98. Long-term capital I realized it's a little different. And it just goes back to what Mark Twain said, history doesn't repeat itself, it rhymes.
Right.
If you get enough of these, these tunes every now and then, you not only get a sense of peace, I wouldn't say peace, but real just calmness, because you've been through this before, you know how the story ends, and you know exactly what not to do. And if you don't do that, you're going to do okay.
Charles and I have something brewing that is coming out in the near future. So subscribe to Charles's channel. Charles, you're on YouTube under Charles Mizrahi, or is there a special thing for the podcast YouTube channel?
I think if you just go to charlesmizrahi.com, you can subscribe to the podcast and my YouTube channel, my Twitter.
Subscribe to Charles. Check Charles out. True legend. Charles, thank you very much. I always wave everyone goodbye at the end. Would you like to join me with a joint wave goodbye? So you can go from left to right or right to left. It doesn't matter. Charles and Paul. What's that?
You got it.
Charles and Paul say bye.
So long. Thank you, Paul.